How's it going, everybody? My name is Antonio, and I'm here today for some resource talks. This time, I'm talking with Anthony Young, who is an ex-electrical engineer as well as an Bear Stearns metals and mining analyst, and a bunch of ex-other stuff. Who then went on to start his own energy transition focused fund in 2017. So it's going to be an interesting talk here between me and Anthony. Who Anthony isn't, though, is your financial advisor. Whoever your financial advisor might be, they are not present here today, and this will be just a casual talk that's general in impersonal in nature between two talking heads on the internet who, for all you know, might be, I don't know, Russian spies or alien spies, which means that you should double, triple check whatever is being said in here. Never listen to us for financial advice. Always wear your big boy pants in the end when you're taking your own decision. That all said, Anthony, thank you for investing your time in me, sir.
Thanks for having me.
Pleasure is all mine, of course. I guess I just gave you a very brief introduction there, but I didn't do it justice. So I also have a mandatory first question for new guests on the channel that will give you the opportunity to better introduce yourself. So why don't you tell me who are you and why do you think you're worth listening to?
Yeah, I guess my background is, like you said, I started off as an electrical engineer. I was working in the aerospace industry in Los Angeles while getting my master's degree in electrical engineering as well. Decided I didn't want to be an engineer anymore, so I went back to business school at the University of Texas, where I got my MBA focused in finance. Really kicked off my investing career or my career in finance at Bear Stearns, where I was in the metals and mining team. We went to Cowan. I say Cowan, it was a place called Dolman Rose previously. So I was at Dolman Rose slash Cowan from 2008 to 2012. Kicked things off on the buy side in 2013. Did that, was in a seat for about a year and a half. Was approached by Macquarie and actually decided to go back to the sell side for a few more years, where I was Macquarie's North American, or excuse me, I was the U.S. Metals and mining analyst before launching my own fund in 2017.
Hmm. How's that been, the experience of launching your own fund in this challenging environment? I guess, launching in, what did you say, 2017?
Yes.
Yeah, so that was pretty cool for like 3 years, and then everything went to something in a basket, right? So how's that been?
It's been a lot of fun. I think launching a fund, you're really and truly an entrepreneur, and there's so much more to it than just picking stocks, right? I think picking stocks is on some level table stakes to be in or to manage a fund or an institution. There's also the accounting, there's the compliance, there's the marketing that all goes into managing a fund. But nevertheless, I am the portfolio manager and CIO. I have a business partner who is the executive officer who manages all of the back office and that sort of stuff. So I'm able to focus a little bit more on managing the portfolio. And like you said, the 2017 to 2020 period, was a bull market, even through 2021, depending on what sectors you're focused on. And the last 18 months have been a little bit more challenging, but still a lot of fun, digging into these themes, different metals, different areas, and figuring out where you can generate returns for our investors.
Hmm. Have you been able to do that? I mean, if you look at, net 2017, the market pretty much any market is up quite a lot. So are you in the green since you started?
Well, since inception, we're certainly in the green. Last year, we experienced about half the loss that the market did. So, it was a reasonable year for us as far as protecting capital for our investors. And then this year, slightly green, but nowhere near. We're not involved in the tech names that are really driving the market right now. So we're not involved in Apple, Microsoft, Facebook, Nvidia. We're not involved in any of that stuff. So there's been some challenges, but nevertheless, I still think it's an exciting time looking forward into the future.
What is sort of the portfolio breakdown right now in terms of percentages and exposure? Because you say it's an energy focused fund. Is this mining and metals specifically, or like what's the breakdown?
So as of today, we're about 80% basic materials, and then 15% industrials, 5% special situations or opportunistic investments that we've been involved in.
Hmm.
So a pretty strong allocation towards the basic material space.
What does that divide in?
That 80%.
Yeah.
So that 80% is, our favorite themes are copper, aluminum, steel, uranium, and tin. We also have a small nickel allocation as well. But the metals that are going to make electric vehicles and wind and solar and nuclear possible.
Hmm. Okay. So wind and solar, nuclear. Okay. So that's quite a lot. Silver's not in there.
We really don't have any exposure, or we don't have exposure to primary precious metals companies. Um, that being said, when you buy a gold company, oftentimes you get a lot of, or excuse me, when you buy a copper company, you get a lot
Yeah.
of gold exposure.
Hmm.
And we have some zinc exposure as well through a copper company, some silver exposure as well. So, we have exposure to the precious metals complex, but no primary precious metals names.
Hmm. I guess that gives me a better idea for the coming talk. That's why I'm sort of setting up the stage as an introduction, but we're going to be hopefully going to be getting more specific further on in the talk about your exposure and your views on some of these metals, specifically uranium. Let's maybe talk about how you do that, how you're able to get that exposure as a fund manager. I'm always interested in how do real people from the sector approach these things. So maybe you can talk to me just generally about your strategy. Like, do you approach the commodity space sort of top down, where you choose a sector first and then figure out what the better companies are, or do you like more bottom up, where you look for good companies and you take them apart and you go into the nitty gritty on the companies?
I think we do it both ways. I mean, we have to like the commodity first, right? So, um, like I said, I gave you the list of metals that we're involved with. And then, we're looking for best in class names in those commodities. And, we aren't involved in the mega cap names, if you will. So we're not involved in Rio Tinto, BHP, Vale, Glencore, Tech Resources, Anglo American. We really like the mid cap names. So typically, if we can find something, less than 5 billion, that isn't as well covered by the sell side. Those are situations that we prefer. Um, Typically, we like names that are producing or near production, right? So I think that if you have construction on an asset and production is somewhere 12 to 18 months away, that's a situation that we would find attractive. We're just not as good as picking the exploration names. We're not as good as picking guys who are out drilling and hoping to prove up resources.
It's kind of funny when you say we're not so much in the big caps, and you say we like companies at 5 billion, and then I look at my portfolio, and probably the average market cap is like 15, 15 million.
Mm-hmm.
So
Yeah.
it's obviously different, different amounts of money there, unfortunately for me. But how do you why not the mega caps actually?
I think the mega caps, it's really hard to express a view on copper, for example. If we really like copper a lot, it's one of our favorite metals. It's much easier to express a view on the copper space in the mid cap area. I mean, everyone obviously, you can express a view on copper and Freeport. Everyone, not everyone, but a lot of people understand that name. But you can find smaller companies that maybe has one producing asset and they're developing a second producing asset, or two or three producing assets and they're producing a much larger um, development project. And you sort of know that you have those cash flows to insulate you in case something goes wrong with permitting or there's some sort of cost overrun or things of that nature. Um, but on that mega cap side of things, there's just so many commodities that are produced by these larger entities, until you could have your preferred commodity increase over the course of a year 20, 30, 40%, and that mega cap name is only up half that amount or a quarter of that amount because they have other things going on, whether it be in coal or geopolitical issues or what have you.
Hmm. Well, you do have more predictable cash flows. So, I mean, in terms of risk reward, um, how do you? I know, or I have heard from other hedge fund managers that they think about the risk weighted return. So not necessarily only think about the return, which is something that I catch myself doing, thinking like, oh, this is a $3 million company, tight share structure, whatever happens, happens. But if this goes up, it can easily 10x. That's sort of the silly thought that I have at times. But then you guys think about, risk adjusted return. So how do you approach that?
Yeah, I think with respect to the the risk adjusted returns, again, and not to pick on the big cap names, because I think that they're some good companies, and I think that they are, for the most part, solid management teams. But when I think about those names, it's almost like you're buying an ETF. If you're buying BHP or Rio Tinto, it's almost like you're buying a commodity ETF, um, except it's all under one roof.
Hmm.
Versus going into, again, just a smaller name. And I think that's something we're going to touch upon, but being able to talk to management and being able to understand um, what the risks are for the name, and but also being able to understand what the return profile for that name will be if they're able to execute. And again, getting that comfort with the asset, getting that comfort with the management team, is, when you have those two things, is when we um, tend to get involved in names relative to, uh, someone that, or a company that has 40 different assets, and maybe you're comfortable with two, but you don't necessarily have a view on the commodity or the country that the bulk of their assets may be operating in.
Mm. So you actually go and talk to management and visit assets, or how do you do that?
So I still talk to management quite a bit. In my younger days, I had the benefit of um, visiting numerous assets. I think I've lost count once I got past 50 or so. So having an understanding of um, the recirculation, if you will, of assets at certain points of time, that you see in the industry, is something that I think benefits my investors and our investment process. But we still, you know, we look forward to visiting assets in the future, but we've had a long history of visiting assets, since entering the industry. And as far as talking to management, I think that's critically important. Um, and sometimes you have to start off with just speaking with the investor relations professionals, and that's they're fantastic mouthpieces for what's actually going on in the company. And as you talk to them over the course of months and quarters, if they deem you to be someone that is reasonable and that's not going to embarrass them, frankly, for putting you in front of their CFO or their CEO. You typically do gain access to management teams, but again, I've been doing this since 2004, so I have the benefit of having worked at large institutions and knowing a number of the executives from even before they were executives in their current seats.
Hmm. That's also something that I find easier in smaller cap names, at least from my side of things, because when it comes down to a $20 million company, you pick up the phone 99% of the time. If they pick up the phone on the other side, it's going to be the CEO, right? Most of these companies, 20, they probably do have someone doing some IR help, but most of them don't really have a full-time IR person. So it's immediately you get to speak to the top dog. So that's one other thing that I do like about smaller companies.
Yeah, no, absolutely. And I think if when you're dealing with those smaller companies, certainly 15, 20, 25 million market cap, paying an investor relations professional is, I'm not going to say it's a waste of money, but you prefer to see them spend that money drilling than, on a person that's just focused on speaking to investors. So I think in that case, it's smart actually. I think it'd be a red flag for a company of 25 million market cap to have a full-time dedicated investor relations professional, because that money can be better spent. I mean, they're supposed to be growing the business more so than anything else.
Right. No, I agree. I agree. Well, I also want to talk about timing, as in when do you typically get interested into a story and what you want to see? Maybe we can kick it off by sort of a cliche, but still a good question, I think. Buying things well or buying good things, which one would you go for?
We tend to buy good things. So, I think that you obviously try to buy well. Your timing is always a challenge, I think, in this industry, right? I think typically by the time, or oftentimes, people have heard of so many different good things, and to think that you're going to buy at the bottom, people oftentimes stand on the sidelines for too long waiting for that perfect entry point versus buying high quality assets and realizing that you're going to own them for a long time. And when I say a long time, I mean 5 to 7 years. Our turnover in the portfolio is less than 20% on the long side of the book. So, we're holding things on average for 5 years.
Nice.
So, if you buy something of a high quality, we're going to see downturns in the market. But, if you're holding something that's of high quality and the cash flows are there, or it's obvious the cash flows will be there in, an 18 to 24 month time frame, those names stand up typically better than, having priced something or pick something at the right price point and getting involved and it possibly not being the highest of quality asset.
Mhm. But it's not like you're waiting for something like a breakout or whatever. I mean, if you look at something right now and you like it, you would just go in, or how do you do it? Like how do you buy your stuff?
Yeah, I mean, I think as far as technicals are concerned, we're not as concerned with breakouts as maybe some other people are. I mean, that being said, if something's been going down, for an extended period of time, you're not going to put a full position on immediately. You're going to begin to pick away at that position, and because, like I said, if something's been going down, the odds are that it continues to go down, and it doesn't make sense for you to put all of your capital to work at that point in time. But as far as waiting for something to cross a 50-day or 200-day, that's not as important to us as the longer term quality of the asset.
Mm. I think that's an important point, specifically for commodity investors, and maybe it's different And you can talk to me about that, whether it would have been different if you were not a portfolio manager. But um, where this is coming from is this coming from a recent article that I read from Haris Kupperman. He's Cuppy. He's by the way coming onto the show soon. But so he was talking about uh, breakout versus sort of not non-breakout investing with chipping away at something that you already think is good value, buying more of it on the dips. They're not going to hit the bottom, but buying it as close to the bottom as possible. And so, but as you mentioned, you do have people who wait for a sector to break out before they jump in. Like with uranium, they maybe want to see a certain price where, oh, now it's 60, so that's gonna, start worrying the utilities a lot. That's gonna get them in, and so on and so forth. So not necessarily a technical breakout. Sometimes it could be a fundamental breakout with some of these commodities, and then they jump in. They basically want the sector to have already been moving and give them a confirmation before they jump in, as opposed to, being a contrarian and buy things that are already cheap and keep buying them as they go lower. So, uh, I personally find it more or easier, better said, for me to do that, buy as things go down, as opposed to wait for the perfect moment and then buy it. Because I get it, theoretically, I should be doing that. Theoretically, everybody should be waiting until the right moment before it starts moving and then buy it, because uranium can be dead in the water for 2 years and then all of a sudden it explodes. And if you can buy it at the end of the second year and you were doing other stuff, like if you bought Tesla before that and you held it for 2 years and then you jump into uranium, obviously you're going to make more money. But is that really something you can sustain as an investor? So a lot of thoughts there. I don't think I have a question, but you can talk to that.
Yeah, no, to your point, I think that you're never going to put on a complete position at the bottom, and you're never going to exit at the top. So you do have to, you don't have to, but to increase your odds of success, having a valuation framework is extremely helpful. I know, you know, in certain areas that's more challenging than others. For example, uranium, it's sometimes more challenging to have a valuation framework or a strict valuation framework relative to copper or aluminum. I think for copper, you sort of know that when something is trading at 4 times forward EBITDA, it's cheap.
Yeah.
When it's trading at 6 times EBITDA, it's probably fairly valued, and if it's trading at 9 times, it's rich, right? And I think it's very similar for aluminum as well, and a number of the other base metals. Now, when you get into uranium, it's a little bit different, right? Because you had long periods of low prices from, if you go back to, pick your time frame, 99 to 2006, pricing was low, and then we had a bit of a spike, and or not a bit of a spike, but the record spike in 2007, and then prices came back, and then prices went a little bit higher into 2011, and they came down for another extremely extended long period. So you've had this incredible price volatility. It makes it a little bit more challenging to have those sort of strict rules, because the uranium market went through a trough period almost like no other basic material went through.
Yeah.
I know folks will probably raise their hand and say that there's been other metals that went through extended troughs like that, but of the major metals, you haven't seen anything similar to that in copper or nickel. They sort of had their cycles, but nothing to the extent. And obviously that was driven by the fundamentals of what was going on with the megatons to megawatts program, and obviously some of the disasters that went on with Fukushima, and long before that, Chernobyl. So it's hard to have that same strict valuation framework like you can in some of the other metals. But I think nevertheless, it behooves you to sort of at least have some sort of a matrix, and or not necessarily a matrix, but a Excel spreadsheet and compare like, oh, this is what I think one company is going to do as far as production is concerned in 2025, and how does that stack up versus some of the other companies?
Okay. But it's not necessarily like, I mean, it sounds to me like you figure out what you like, you trust your analysis, and you start building positions. It's not like you wait. That was the whole point, I guess, that Copy was trying to make, that he doesn't necessarily wait for the market to give him confirmation that his analysis was good enough and then enter. He's sort of like, okay, I did my research, made my analysis. This is good. I'm going to start entering. And if it falls, I'm going to buy more. So, yeah.
Yeah, I think that's exactly right. I think if you do your analysis, and again, coming back to the copper markets, because that's just one that people know. If you do your analysis and you speak with management and you come to the conclusion that this name is trading at 4 times forward EBITDA, and sort of pick your copper price, whatever that may be, 375, $4. I wouldn't use much a higher copper price than that right now today. But using that sort of analysis, you say, hey, this name's trading at 4 times. Granted, if copper prices go to $455, then that's just gravy to your story. But if you come to that conclusion that, hey, at this sort of reasonable copper price, my name is trading at 4 times, and it goes from 4 times to 3.9, 3.8, 3.7, and you re-underwrite your thesis and everything still remains intact, you should be comfortable adding to that position.
Is it mostly financial valuation metrics that you're using when you're picking your own, I mean, the moment to start buying?
I mean, I would say it's a mosaic, right? So there's no one trigger that's going to say, hey, today's time to buy.
Hmm.
Some of it comes down to the portfolio, and if people are contributing cash to us, um, you know, we don't necessarily sit on cash for extended periods of time. I mean, if we have a bit of a cash position for 2 to 3 months, then that's fine. But ultimately, people give us cash to deploy that into the market, not to sit and time the market on hopefully getting the best possible price.
Mhm. What part of your portfolio does generally stay in cash?
Fairly low. I mean, right now we have a little bit, just given some of the market volatility that's going on, but typically we like to be less than 5% cash.
Less than 5%. Okay. So that's not above 5% now?
We're a little bit above 5% right now.
Hmm.
Yeah.
Well, I guess that sort of fits in line with the Bank of America study of fund managers. They do that monthly, and that's sort of around that. People freak out when it's a little bit above 4%, and then they think that everybody's bullish when it's a little bit under 4%. Why that number? Like, why 5%?
I mean, that's a good question. I think just as far as the operations of the funds, having about 5% is useful. And just to give you a little bit of clarity on why we're above that, we had a large position in
Hmm.
Copper Mountain Mining, which was taken
Nice.
out recently by Hud Bay Minerals. And on the shortly after that announcement, we sold the position in Copper Mountain, and we just haven't redeployed that cash yet.
How do
Um,
you decide that? That's an interesting decision that you made selling Hudbay, um,
Copper Mountain.
like, selling Copper Mountain when Hudbay bought it. Um, how do you decide? Like, what do you need to see? Is there one fixed thing, or is it sort of a case per case basis?
It's on a case by case basis. I think that we've been long term owners of Copper Mountain, and we have other copper positions in the portfolio, and it just made sense for us to exit at that time. So, I think that the an acquisition occurring is a pretty good time to just reevaluate where you are with all your copper positions, where you are in the portfolio. And again, we still see a fair amount of volatility going forward. And to us, it made sense to, um, you know, take that position and monetize it, and have some cash on the sidelines for potentially, other opportunities which may emerge over the next, 4 to 6 months.
Mm. And that's
We don't
still,
have a crystal ball on that. And when I say that 4 to 6 month time frame, it just seems like, again, for us, we're not macro guys, but we do look at PMIs, and we do look at other leading indicators, and all those leading indicators, not all of them, but a large majority of them are flashing either yellow to red. And in that sort of environment, we just said it'd be nice to have a little bit of cash, particularly given, um, the transaction that had just occurred.
hmm. Okay, fair point. So but you don't have like a fixed evaluation, like, okay, once a month, we're going to sit down, we're going to look at our holdings, we're going to see what we're going to throw out or keep, or once a year or once a quarter.
I mean, I think for us, it is definitely it's ongoing. So, you say once a month or once a quarter, but I would say it's on some level, it's weekly. And looking at the news stories that are coming across and evaluating how those news stories impact our thesis. And not every company has a news story coming across every day or every week, but across the portfolio, typically we like to be about, well, today we're at 11 names, but we typically like to be about 15 names in the portfolio. But thinking about those 15 names, at least once a week, some news story will come across on one of them. And then figuring out how that news story impacts our thesis. And has it changed the thesis? Has it strengthened the thesis? Or is it maybe a news story that is getting headlines, so it's really a non event?
Okay, so you're fairly concentrated. That's interesting. I like concentrated portfolios. That's also a challenge, I guess, to manage when you're managing that much money. I mean, that I don't know exactly how much you're managing, but I'm assuming it's at least a little bit more than I do. So how do you manage that? How do you look at diversification?
I think that being concentrated, while some people view that as being risky, we view it as a risk mitigation tool, right? Because we know our companies extremely well. We know their assets extremely well. We know their management teams extremely well. And you can gauge, on a conference call when a management team says something different. Are they starting to change their thesis? Whereas if you have a portfolio of, 100 names, um, it's harder to keep track exactly of, it's hard to keep track of assets. And when I say assets, I mean mines in particular, or producing assets, or, if it's a steel mill, or something of that nature,
Yeah.
it's harder to keep track of all of those. But, I think that I think the best way to generate excess returns is to be as concentrated as possible. So, you know, I think that, you know, just using round numbers, if you have two companies and one's up 100% and another one's up 30%, it'd be great to be up the name that's 30%, but the reality of the matter is you've been better off if you were just completely vested in that one name that's up 100%. So, not saying that you should only be in two names, but, as you multiply that out to 5, 10, 15, 20, you're typically best served to have the maximum amount of capital that you can in your best idea.
Right.
And we find that once you get past 15 ideas, you start to dilute yourself.
Mm. No, I find that to be true, and definitely recently. So I agree with that point. I want to move on to talk about your outlook here on the markets. You said you're not macro guys, but you said that some of the indicators that you're looking at are flashing red or yellow. Let's maybe start with a broad view on where you think the market is right now. Sort of if we got on a plane and we look down from a sort of 40,000 foot view perspective, what would we see?
I mean, it's an interesting time, right? Because, we have increased 20% from the October lows. So people say we're in a bull market. You open up the Wall Street Journal, Barron's, FT, pick your financial daily, if you will, and they're all talking about being in a bull market. But then when you start to look at, you know, PMIs and you look at, or purchasing managers, the PMI, the purchasing manager index, for folks who aren't familiar with that, or you look at some of the housing data that's out there, new construction starts, if you will, of residential housing. Those are all pointing towards recession, if you will, and in some cases, recessionary environment as strong as the 2007-2008 timeframe. So from our perspective, again, we don't have a crystal ball on whether or not we're going into a soft landing or a hard landing. Um, we think that it's less likely that there is a no. We don't buy into the no landing camp, if you will. But it seems like we're headed into some economic weakness, and that just gives us some pause. I think that you typically don't see, and just using copper, for example, as a broad metal snow, you typically don't see copper prices bottom before the recession. They bottom at some point in the middle towards the end of the recession. So with that sort of thought process used across the metals, it seems like it's time to be somewhat cautionary.
Hmm. It's an interesting point about copper because I've been looking at something and I know ratios can get superficial and they can give a lot of false positives. But what's been happening over the last year is that copper is down double digits while gold is up about 5 or 6% or something on a year basis. And normally, you know, that would indicate that and those are said to be forward looking commodities. That would indicate that people are expecting there be less industrial demand, so less demand for copper, while more demand for safe haven. Eh, so how do you look at that? What's that telling you about the economy? Do you ever look at ratios and stuff like that?
I mean, there was a point in time when I would look at all of those ratios, and I would run those ratios for a weekly publication that we used to put out when I was working on the sell side. So, um, gold to oil, copper to gold, silver to gold, or gold to silver. Um, and really, just because I was putting the numbers in Excel and looking at them, I would think about them a lot. Um, and I'm not sure that's the best use of my time at this juncture, as far as, or mental bandwidth, I would say. But to your point, I think that what you're saying is exactly right. That there is underlying fear in markets, and that's expressed through gold. Um, I'm not going to say it's because it's come down off of 2000 and change, so people are saying gold is down, but it's not really when you look at the chart over a longer time frame. I mean, maybe over a 4-month time frame, gold prices are down a little bit, but very little, particularly relative to copper, which has come down quite a bit. So I think that, um, you know granted, I'm expressing some risk, or some fear of what may be to come. But that being said, we still have a large amount of our capital invested in markets, but trying to be more conservative. And again, when I said that Um, we will invest in companies that are in construction and have a clear line of sight to production. You know, right now we're probably more heavily weighted towards companies that are producing and are generating cash flow and can pay dividends and buy back shares than companies that, may not have production until 2024
Hmm.
or later for that matter.
And that's because you're expecting more pain in the copper price, I assume.
I would say it goes across a number of commodities, but yes, yes, copper and other commodities.
Hmm. Copper specifically is an interesting one because we're seeing imports in China dropping. The issues in Peru got largely resolved, so copper can be shipped out again. The stockpile that was stacking up in Congo, um, also largely resolved, can start hitting the market right around the time that Europe is entering a recession, has entered a recession actually as of last week, and the potential for one in the US as well. So I tend to agree. How long do you think it's going to take us to work through all that and have copper back going up?
I think that's the $1 million question. I think that when I tend to think about copper, um, you're playing two different themes, right? You are and the primary theme really that they kind of go hand in hand. It's electrification and to a lesser extent and still ongoing, but less than where we were in the 2003 to 2012 timeframe is urbanization. So, I think that people tend to think of the electrification being a Western world phenomena, but really it goes hand in hand with urbanization. So, when you look at the amount of copper consumed or the amount of electricity consumed by India or by China or by different regions in Africa, far, far, far below, um, where we are in the Western world. And I think that electrification continues over an extremely long period of time. So it's not going to continue. This isn't just a 18 to 24-month phenomenon, or it's not even a 2020s phenomenon. This is something that's going to go on certainly out to 2050 and probably out much longer than that. So, as far as what's going to happen in copper over the next 18 to 24 months, I'm not going to say that I don't care, but I think it's less relevant to the longer term opportunity that's there for investment in copper, particularly higher quality copper names. So, yeah, I mean, I'd leave it at that, or else I could talk about copper all day.
Yeah, it is a $1 million question because I think once copper turns, a lot of other things will turn because of the nature of the beast here. So, is there any other commodities that you would tend to be bullish on despite all of that? I mean, uranium pops up to mind for me, obviously, but anything else for you?
Yeah, I would agree with you. We're long uranium. We're also we have investments in the tin space. I think that we talk about copper and electrification. Um, Tin is really like copper on steroids. So if you think that you know there's going to be this electrification and we're going to go towards net zero in 2050, which is what most people are talking about. I think maybe China is talking about 2060. But if we're going to go towards that, tremendous amounts of tin will be consumed in electric vehicles, be consumed in um, solar systems. I was reading some things about the excitement obviously around NVIDIA and chips and all of those chips that NVIDIA and Micron and everyone else will produce, they all have tin in them. So, I think that's one of the things that's not as well appreciated about basic materials and base metals is when you think about base metals, people just sort of lump them all in as this happened in China and prices are going higher, or something else happened in China and prices are going lower. But each one of these base metals and steel and a couple other metals that are out there, they have very specific drivers that can have them separate and diverge from the other base metals depending on what's going on.
Hmm. So copper, uranium, what else have you got in there? You said nickel, that's an interesting one. What's bringing you into that market? I spoke to Lobo Tigre, yes, no, a couple of days ago, not yesterday. He doesn't like nickel. So why do you like it?
I mean, there are challenges to the nickel space, right? I mean, there's a lot of nickel in Indonesia. Uh,
Hmm.
that being said, I think that, and there's still a debate on which way battery chemistries are going to go. I think that the nickel, cobalt, manganese is still, I'm not going to say the most prevalent, but if you want a performance vehicle of the type that we like here in North America, that's going to be the preferred chemistry. Um, you have your lithium phosphate iron batteries as well, which are gaining traction in some of the entry level electric vehicles. But I think that the demand that will emerge for nickel over the longer time frame is going to outweigh some of the supply that's out there, right? So I think that again, Indonesia very well may ramp up their nickel production, but I think the demand will be of such, and particularly, if they ramp up their nickel production and get that pricing to a level that's affordable, there'll be no reason to substitute nickel or to substitute into other battery chemistries. And that demand profile will be of such that over a longer time frame, um, you should do very well in nickel. So right now we just have the one position on, and the company that we're invested in is basically the lowest on the cost curve, and if not lowest globally, it's the lowest hard rock mining producing nickel producer. So from that perspective, we find it an interesting commodity.
Hmm. Okay. So we have uranium, nickel, copper. What else should we be talking about? Like, I feel like I want to ask you about oil, but I almost feel like that's going to be a crime asking you about oil and natural gas and coal. But anything else you want to talk to me about?
So yeah, I mean, on the oil and natural gas, not strong views there. I think that coal is an interesting commodity, right? I think that for us, um, when we started the fund, we were short coal, and that was more because of the capital structures that were in place in the industry in the
Hmm.
2017, 2018 timeframe. The management teams had taken on a lot of debt from acquisitions that they had done in the early portion of the decade, 2010, 2011 timeframe. But now you've had a restructuring of all of that debt for all of these companies, and they're generating pretty tremendous cash flows. So we're not involved on the long or short side for coal. But for me, actually, my first job in finance was to work on a coal team,
Hmm.
and it's something that we keep our eye on, but not something that we're involved with.
Hmm. Okay. I feel like these markets are almost too difficult for me to follow up with because they're also so very politicized. Specifically oil maybe, but also some of the other energy commodities too. So I've largely stayed away, and there's always something happening, something moving the price. Most people expect it to keep going up, but then oil, as you're seeing right now, is going down, and like it almost makes no sense to me how it works. So yeah. Well, what else can we talk about within the basic metals part of your portfolio?
I mean, I'm always excited to talk about tin, which we touched upon, or we can move over to uranium, whichever you prefer.
Well, tin is an interesting one because it seems like it seems like you're bullish on it, but it also seems like Malaysia Smelting is looking to increase production. Alpha Mint, pretty much the only viable company I guess out there, for as far as I know, recently found quite a lot more tin, and it announced that it's going to go from a 4% of the world supply to now 6% of the world supply. They're printing money at the current level, so they don't have a reason to stop increasing production. So it's like it's been a shaky commodity in terms of fundamentals. So yeah, talk to me. Why do you like it?
I think again over the longer term, when you look at the demand profile for tin, incredibly attractive, right? So as we talked about on the solar side of things, I say 70 tons of tin goes into every gigawatt of new solar production. I think the exact number is 74 tons of tin. On the electric vehicle side of things, it's as 2 to 3 times as tin intensive as internal combustion engine. But when you talked about these assets that are out there, Alphamin, Malaysia, um, maybe Peru can squeak out a little bit more tin, but then that's really it. There's Myanmar, which is seemingly their tin production is decreasing. Indonesia has a fair amount of tin assets, but they may put an export ban into place over the next, pick your time frame, 6 to 9 months, certainly within 2 years, similar to what we saw them do in nickel and to a lesser extent copper. So, I think it's a commodity that's extremely important for electrification. But then on the supply side of things, where that additional supply will come from is really in question. I think that when you think about copper or uranium, for example, you sort of know where the big copper deposits are out there, and you say, well, if copper prices get to 425 and it looks like they'll stay there, then company XYZ will probably start to um, increase their drilling and do some additional studies and look to reach a construction decision. And conversely, on the uranium side of things, you say, well, if uranium prices get to 75 bucks, then I know project XYZ in the Athabasca Basin or possibly in Africa will ramp up and they'll look to enter production. Conversely, on the 10 side of things, um, 10 prices got to $50,000 per ton. I think today they're at $27,000 per ton or something of that nature. But when 10 prices were up at $50,000 per ton, it's still outside of Alpha Men. It wasn't obvious who was going to turn up additional production. So I think you could see 10 prices move substantially higher, and it's really comes into question, where that incremental ton of production will come from.
What's the thing going to be that's going to be moving them higher? I mean, with uranium, I hope we're going to talk about it. It's pretty obvious. Replacement rate contracting, basically contagion in the contracting of utilities, more utility buyers coming in. It's going to spur off some buying. Long-term price is going to go up. Producers are going to start making more money. What's the thing for tin that is, what's the catalyst that's actually going to push it higher?
I think that's the challenge right now, right? Is that, if you're staring into some sort of economic weakness, there isn't that obvious catalyst that's going to take 10 from 27 to 35, in any set time frame. I think that, again, more broadly speaking, it's just these trends of going towards net zero, towards the electrification of everything that is really going to benefit 10. And that unfortunately doesn't have a set sort of catalyst that you may wake up one morning and prices have taken a step function higher.
Right. Yeah. Something like Myanmar's Myanmar's military taking control of the mines and then saying no more tin output, or you know, God forbid, not wishing it for anybody, obviously, but like a fire in Alpha Man or something like that can really be detrimental to these things.
Right.
I get that point. Yeah, yeah. Okay, well let's do talk about uranium. I saw an interesting chart on Twitter. It was shared by Willem Middelkoop of the it's called the criticality matrix. It's a medium term criticality matrix from 2025 to 2035. And so they rate it on a supply risk scale of 1 to 4 and an importance to energy scale of 1 to 4 as well. Uranium ranks as a 4 on importance to energy, but then in terms of supply risk, it ranks as a 2, which to me was interesting because as far as I'm concerned, it would rank at least a 3, if not even a 4, with the Kazakh book now potentially being full by China, chemical book almost full, no other large producers. So how do you look at it in terms of criticality, I guess?
Yeah, I think that's right. I think that a large part of it comes down to price, because at the current price, it's uncertain where additional supply comes from, right?
Mm.
I mean, I think that we're at 57 today, I think, depending on
Actually
who's no.
taking on 58 on the spot market as we speak. So
Okay, okay.
exciting times.
Yeah. So 57, 58, and we get excited about prices going up $1 here, but that's not going to move the needle for any producer. I mean, no one's saying, "Hey, I got to send more drill rigs out because pricing." I mean, even price. Just this year, you would say, broadly speaking, pricing has gone from 50 to 58, and that's really not incentivizing anyone. I think that pricing needs to go substantially higher to get that next leg of production out of the ground. Um, now, on that criticality chart, I wasn't familiar with that, and I think I missed that one. But just thinking about how important uranium is, I guess, for life. It is like 10% of global electricity. So, and obviously, just small amounts of that production or that electricity production coming off would have huge amounts of impact on society. So, I think it's one of those commodities, and I use FactSet, for example, for most of my data services. You still can't get a live uranium price on FactSet anywhere. So there's this group of people that are interested in uranium, and I think that the communication between those groups of people makes people feel like everyone knows the story, but your rank and file investor still, you mention uranium to them, and the first thing they talk about is Fukushima, and then the second thing they talk about is I saw the HBO special on Chernobyl. This is not where I want to make an investment. So I think that we're excited about it, but there's still a whole world that is completely um, isn't informed on the story.
Mm-hmm. Yeah, I tend to agree. So the long-term price is probably higher than that right now. I believe at the end of the month, last month, Chemical reported it, and it was higher than the spot at that time. But it seems like the spot price is going to start climbing above the long-term price here very soon. Did you put any importance on that specific thing happening in terms of the dynamics and the inner workings of the uranium market?
I mean, that one's a challenge for me, right? I mean, I know that there's a school of thought that long-term prices are the only thing that are important, right? Um, and I think that given the size of the uranium market, that may remain true. Um, Conversely, you know, spot markets are again, we were talking about spot prices, and spot plays a very important part in price discovery in every market, right? I think that, not to date myself, but when I entered the commodity industry, Iron ore was priced annually. You got your annual iron ore price in the September-October timeframe, and that's what it was for the year. BHP, Rio Tinto, Vale, everyone else just supplied into that long-term market, and that changed over time. I'm not sure that you'll necessarily see that same change in uranium markets, but it's interesting to watch.
Hmm. Yeah, definitely is interesting to watch. Looking at that chart here again, and it seems like nickel is also marked as more critical in terms of supply, but also some other stuff like there's cobalt. Actually, nickel is up there with lithium. Supply risk 3 out of 4, importance to energy 4 out of 4. That's kind of surprising to me, but you just explained that. But as we have cobalt, graphite, they're also in the upper echelons, I guess. Um, is there anything else besides uranium and nickel and copper that you have a big exposure to?
We still have exposure to steel and steel markets. I think that we've decreased our exposure some, but I think when you think about energy prices for the long term, steel is one way to express the likelihood of higher energy prices. When you think about the electric arc furnace, incredibly electricity intensive, which essentially is a proxy for natural gas. Blast furnaces less so, but I think that on the blast furnace side of things, they're undergoing intense pressure relative to the amount of carbon that they emit. So if you start to have some sort of carbon tax put into place, that could impact their cost structures as well.
Hmm. It's interesting because China has been kind of struggling with that with steel production recently, right? Because as far as I understand it, they sort of overproduced over the last 52 weeks for them to meet their climate goals or whatever it might be, and so they're now going to be producing a little bit less for the remainder of this year. So demand for iron ore is also supposed to go down. On the last report for me, they actually imported more iron ore. They had an uptake, so iron ore seems to have hit some type of intermediate term bottom. So I don't know.
So, I mean, the one thing that I've learned over the longer term, right, is lower steel production in China, or quotas, if you will, um, oftentimes means higher iron ore prices. Because what happens in China is their iron ore is of such low quality until they want to use the Australian material, which is obviously 62, 65% Fe content, relative to that Chinese iron ore, which can be as low as 30 to 35% Fe content, sometimes even lower from what we've heard. But if you have, and oftentimes what the Chinese do is they say, we're going to shut down these blast furnaces and we're going to allow these to operate. And so if you're left with the blast furnace that's operational, you want as much production as possible. And the way that you can increase your production is by using the highest quality iron ore. So despite the fact that China talks about cutting their steel production, they want the highest quality iron ore, and that highest quality iron ore is typically going to be an imported product for them.
Hmm. Hmm. Yeah, another market that I know nothing about, so I don't think I can add anything here. Um, I think I'm sort of at the end of my list. I also know that you probably have to go because we've been talking for almost too long now. Is there anything that you came here hoping to talk about, but I'm failing to bring up?
No, I mean, I think that that about covers it. I mean, the one thing that I did sort of want to talk about, and the reason that we're optimistic for the longer term for this cycle is, really the employment situation that has been occurring in metals and mining. So, or that when I say employment, I would say that the lack of talent that there is in the industry, and it's something that we've been talking about a lot over the last 3 months. I think that previously, in previous cycles, there were miners and there were mining engineers that were waiting to come back into the industry, to turn up this next generation of mines.
Mm,
But when you look at the talent that's out there, now, it's aging. There was a study that was put out that was talking about the average miner in the United Kingdom was on the order of 55 years old. Miners typically retire at an earlier age than accountants and lawyers and things of that nature. They don't typically work much past 65. Oftentimes they're retiring at 62 if possible. There's, you know, that that lack of a workforce is going to lead to higher prices as the industry needs to incentivize younger people to come back to the industry. So I think young people now are obviously very interested in computer programming, and they're interested in robotics, and they're interested in artificial intelligence. And you can do that from the comfort of your home in often cases, or certainly in office buildings that are close to your residence. But to get people to travel, to the Yukon Territory in Canada, and to Alaska, and to Africa, and in regions like that, you're going to have to pay people more than I think what the industry has been accustomed to. So, when you're looking at those pre-feasibility studies and those feasibility studies, if they're 2 to 3 years old, particularly on that employment part of, or the mining part of the cost, those costs may be substantially higher than what's in those studies.
mm. I think labor is going to be an interesting one because I am not convinced it's really only about money because I'm hearing from guys in the industry saying we can offer a good six figures, so not high six figures, but like 150 to $200,000 a year.
Mhm.
People just don't show up to work, and sort
Right.
of the quality of people that show up for work is not where we need it to be for decent production. And maybe it has something to do with the prestige or just how cool of a job really is. I mean, you live in LA, and you probably come across a lot of hipsters. I live in a metropolitan European city, so I do too. Um, I cannot imagine almost anybody my age working in an actual mine, and mining engineers are rarer and rarer. If I look at the curriculums over here in the colleges in Belgium, we don't even have that, which makes sense. Okay, we're in Belgium, Europe, and so on and so forth, but we used to have that. Same thing for the nuclear industry. There used to be a nuclear physics program at the bigger universities. I think there's only one university offering that now in Belgium. Um, I mean, it's interesting. It's interesting whether is it really a money issue? And I guess it always is in the end a money issue. But how far does it go? Like, do you have to offer people seven figures to go work in a mine? Is that really sustainable for the mine? What does that mean for the cost, and so on and so forth? So, yeah, it's thoughts that I've been having as well.
Yeah, and I think that, to your point, it goes beyond the salary, right? It goes to, when you go to these sites, um, for a point in time, they were doing a really good job. I think in that 2003 to 2012 timeframe of, having really modern gyms and really great food and things of that nature. And yeah, that's going to be absolutely mandatory. I think if you want to incentivize someone to come to your location, and again, having that fantastic food and maybe different video game systems, and what have you to keep your employees entertained, that's just additional cost that will have to be borne by the production of that facility. Or it could very well be, instead of working for 2 weeks on and 1 week off, you're having to give people 1 week on and 1 week off, and flying folks back home more often. And again, these soft benefits, they don't translate to necessarily the miner having more money, but it definitely translates to a cost for the shareholders, because they have to incentivize those folks to get to these regions that are less desirable than being in some of these major metropolitan centers.
Mm, I agree. It's definitely going to be an interesting thing to watch. but it essentially probably leads to higher prices, as you said. So yeah, yeah, good point. And thank you so much for doing this. I hope we can do it again. It was an interesting discussion. I think there's like 10 discussions that could have been started from this, but this I don't think anybody's looking forward to a 10-hour discussion. Besides me, I like doing these long things. But yeah, thank you so much, and I hope we can do this again.
Yeah, absolutely. Thanks for having me on.